Have you ever, looked at a company's valuation and thought, hold on, is that all there is to it?
Yeah, that feeling. Almost like a magic trick, right?
Exactly. You see the big presentation, all shiny, but what's hiding behind the curtain?
That suspicion can lead to some seriously interesting deep dives.
And that's where we're going today. This time, we're digging into a story you brought up about a hedge fund, Greenlight Capital, going head-to-head with a company called Allied Capital. This was back in the early 2000s.
A real David and Goliath kind of story.
Absolutely. Except instead of a slingshot, we've got accounting practices and maybe some creative valuations.
Right. And we're basing this deep dive on a pretty detailed account. Seems like it was written by someone close to Greenlight.
Okay, so we're getting the inside scoop. What kind of stuff are we looking at?
Well, there are some key players, of course. Bill Walton, the CEO of Allied Capital, for one. And then there's David Einhorn from Greenlight.
Got it. The main contenders.
Plus, we've got journalists, analysts, everyone tracking this whole battle.
A real financial showdown.
We'll even be looking at specific events, like a speech at a charity conference in 2002. And of course, lots of documents, SEC filings, internal reports, the whole 9 yards.
So what's our mission here?
To break down how Allied Capital was valuing their assets, why Greenlight was questioning those valuations, and what it all means for investors. Like how transparent are the markets, really?
Right, because this isn't just about one company, is it? This is about how the whole system works.
Exactly. Okay, so let's start with Greenlight's first moves. What's interesting here is how committed they were.
Yeah, they didn't just dip their toes in the water.
Not at all. Our sources say they shorted Allied Capital stock big time, between 3 and 8% of their capital over 6 years.
That's a serious bet against the company.
Definitely. And it wasn't all about the money either. There's this whole charitable aspect to it.
Oh, right. Tell me about that.
So back in 2002, the guys running Greenlight, they publicly said they donate half of their profits from this Allied investment. It was going to a pediatric cancer hospital.
Wow, so they put their money where their mouth was.
Literally. They even gave $1 million in 2005, before the whole thing was even settled. And later, when the book about this all came out, they said the rest of their profit and the royalties would go to the Center for Public Integrity and the Project on Government Oversight.
So it was about exposing something they thought was wrong, not just making a buck.
It seems that way. Now, Allied Capital, they didn't exactly welcome this scrutiny.
I bet they didn't.
Not one bit. Their lawyers sent letters to the book's publisher, trying to stop it from being published. They did offer to talk to the publisher to make sure everything was accurate, but when the publisher said, hey, why don't you talk to the author directly, Allied refused.
Classic avoidance tactic.
Right. And this fits their whole pattern of not engaging with hedge funds. Basically, they wanted to control the narrative.
Makes sense. So what was Bill Walton's mindset during all this?
Well, there's this quote from him back in 1999 where he says that building a business isn't always smooth sailing. He also talked about how important it is to figure out the root of a problem. Is it a bad system or is it a bad person? If it's a dishonest person, you get rid of them.
So he was thinking about individual bad apples or maybe problems with the whole company structure.
Yeah, but maybe not so much about flaws in their methods for valuing assets.
And that brings us to the heart of Greenlight's argument, right? They were saying there was this huge gap between how Allied valued things and what those things were actually worth.
Exactly. Like they were inflating the numbers to make their finances look better than they were.
And they had some pretty specific examples, right? What about those Velocita bonds?
Ah, yeah. Those are a prime example. There's this conversation in the source material between someone called Loeb, probably from Greenlight, and someone from Allied, probably Joan Sweeney. They're talking about these bonds. Loeb points out that they're trading 2 cents on the dollar, but Allied's got them valued at $40.
$40 versus 2 cents. That's insane.
Right. Talk about a discrepancy. So Loeb's basically saying, look, I can buy these things for 2 cents. Why are you saying they're worth 40?
What was Allied's excuse?
They basically said there wasn't really a market for these bonds. Like you could only buy them by appointment. But Loeb shot back saying, well, I can make an appointment and buy them for 2 cents. So why are yours still at 40?
That's a pretty weak argument from Allied.
It is. And it gets to the heart of the issue. Were they allowed to just ignore the actual market price, even if it was a thin market, and use their own valuation instead? Under normal accounting rules, you're supposed to use the fair value, and the fair value is usually the price things are actually trading for.
So Allied was bending the rules, at least in Greenlight's eyes.
Big time. And it gets even more complicated when you look at how they treated loans that weren't performing well. The source calls their method the "you have got to be kidding me" method.
Okay, that doesn't sound promising. What did they do?
Basically, they kept valuing loans at their original cost, even if the borrower wasn't paying interest anymore. They called these grade 4 loans. Their logic was that as long as they thought they'd eventually get the principal back, the loan was still worth what they originally lent.
But that's not how investing works, right? If someone's not paying you back, the value of the loan goes down.
Exactly, it's basic finance. But Allied was acting like these bad loans were still perfectly good, like magic. This really threw up red flags for Greenlight.
So we've got inflated bond valuations and loans that are being treated way too generously. What else caught Greenlight's attention? The sources mentioned something called BLX.
Yeah, Business Loan Express. That was a big part of Allied's portfolio, and it became a major focus for Greenlight. One of the main concerns was something called gain on sale accounting.
Okay, break that down for me. What's the risk there?
So with gain on sale accounting, a company can basically say they've made a profit when they sell something, even if they haven't actually gotten all the money yet.
Like selling a car on an installment plan and claiming the full profit right away.
Sort of. The problem with BLX was that they originated and then sold SBA guaranteed loans. And the way they calculated their profit depended on how long they assumed these loans would last. If they assumed a loan would last 11 years, but it was actually paid off in 4 years, like what Chovia Securities estimated, then they would have overstated their profit up front.
Ah, I see. They were assuming those loans would generate income for much longer than they actually did.
Exactly. And the source points out that Allied wasn't very transparent about these assumptions. They didn't disclose how long they expected the loans to last, so outside analysts couldn't really check their math.
More otacity, more suspicion.
Right. And it gets worse. There's this example of a loan for a gas station in Detroit. It was a total mess. BLX apparently loaned way more money than the gas station was actually worth. The appraisal was inflated, the borrowers had no experience, and they never even made a single payment. It took BLX a year and a half to even try to collect.
That's mysteriously bad lending.
It is. And it wasn't just external analysts who were worried. There's an email from a former senior vice president at BLX who said he was forced to resign in 2001 because he kept pointing out these massive underwriting deficiencies to Allied's management.
So even people inside the company knew things were bad.
It seems that way.
Yeah.
Now, of course, Allied didn't just sit there and take all this criticism.
Yeah.
They went on the offensive and accused Greenlight of a short attack. Basically, they said Greenlight was just trying to manipulate the stock price to make money.
So it was a war of words with Allied trying to discredit Greenlight.
Exactly. But Greenlight fired back, saying that Allied hadn't actually found any factual errors in their analysis. They challenged Allied to point out anything that was wrong and said they'd correct it publicly if they did.
A real battle of credibility. Now, did Allied change anything about their financial reporting after all this?
Well, they shifted their focus a bit. Instead of emphasizing their net investment income, which is the money they make from interest, dividends, and fees, they started highlighting their taxable income. That includes the net investment income plus any capital gains they make from selling assets.
So they were trying to show off the profits they made from selling things, even if those profits were one-time things and not as reliable as their regular income.
It seems that way.
Mm.
And they also stopped giving guidance on their earnings and only focused on their dividend. Their dividend was tied to their taxable income, so maybe they were hoping investors would focus on that instead of the performance of their investments.
Clever, but misleading. What about the other big investors? Were they paying attention to Greenlight's analysis?
It doesn't seem so. There's a story about a meeting Greenlight had with Stewart, who was one of the biggest shareholders in Allied. Greenlight asked him about their analysis, and Stewart admitted he hadn't even read it.
Wow, so maybe some of these big investors were just happy collecting their dividends and not really looking into how those dividends were being generated?
Maybe. But even Stewart's fund eventually sold all their shares in Allied. So maybe the concerns finally caught up to them.
Maybe they realized something wasn't quite right. The sources also mentioned something about Allied trying to orchestrate a short squeeze. What was that all about?
A short squeeze is when the price of a stock that's being heavily shorted starts going up really fast. This forces the people who shorted the stock to buy it back to cover their positions, which can drive the price up even more.
A self-fulfilling prophecy, almost.
Right. And the source suggests that Allied's management, including Bill Walton, encouraged their shareholders to recall any shares they had lent out to short sellers.
So they were trying to make it harder for Greenlight to maintain their short position.
Exactly. If Greenlight couldn't borrow any more shares, they'd have to buy them back at whatever price the market dictated, even if it was artificially inflated.
That's a pretty aggressive move. It seems like they were more interested in punishing Greenlight than addressing the actual concerns.
It does seem that way. So what about any legal action? Did anything come of all this?
There was a class action lawsuit, wasn't there? What happened with that?
A judge in New York dismissed it. He said that because Allied had publicly disclosed their accounting policies in their SEC filings, the plaintiffs couldn't really prove that Allied was hiding anything or that they were violating their own policies.
So even if the policies were bad, the fact that they were public knowledge protected Allied legally.
In this case, yeah. But the legal scrutiny didn't end there. The SEC launched their own investigation into BLX's gain-on-sale accounting.
So the regulators were taking notice?
Oh, yeah. And then there's the investigation by Kroll, the investigative firm. And the Small Business Administration, the SBA, was looking into things too, because they were guaranteeing a lot of BLX's loans.
Let's start with Kroll. What did they find?
They focused on two main areas. First, there was American Physician Services, or APS, a company that managed physician practices. Kroll's findings weren't good. They said APS was basically a sinking ship, and Allied wasn't going to get their money back. They even called APS's management incompetent, dishonest, and crooked.
Yikes. Not a good look. What about BLX?
That investigation was a bit more complicated. Kroll had trouble getting the SBA loan records they needed, but they eventually found evidence that BLX was using loan proceeds for things they weren't supposed to.
So potential misuse of funds.
Yeah. And they shared their findings with the SBA.
What did the SBA say?
Their internal review basically confirmed what Kroll had found. They said BLX had a lot of delinquent loans, and their default and liquidation rates were way higher than the SBA's own benchmarks.
Not a good sign.
Not at all. The source also mentions a report from the Office of Inspector General, the OIG. That report was really critical of the SBA's oversight of BLX. It said there were major problems going back to 2001, but the SBA kept renewing BLX's lending authority anyway. They didn't do anything to stop BLX from making more loans or to reduce the risks.
Sounds like the SBA was asleep at the wheel.
It does, doesn't it? And the report suggests there was a conflict within the SBA. They were so focused on making more loans that they weren't doing a good job of overseeing the lenders.
So the watchdog wasn't really watching.
Right. And this report was heavily redacted, which makes you wonder what they were trying to hide.
I know the sources mentioned Senator Kerry getting involved.
Yeah, he wanted the full report to be released.
Hmm.
He was concerned about transparency and protecting the small business loan program. But it seems like he was more focused on criticizing the redactions themselves than on pushing for BLX to be shut down or for anyone to be held accountable.
So politics were definitely at play.
For sure. There was even a Senate committee hearing where SBA officials and the CEO of BLX had to testify. And during that hearing, one of the SBA officials said something unbelievable. She said BLX had offered to repay one of the bad loans, but the SBA told them they didn't need to.
Wait, the SBA told them not to repay a bad loan.
That's what she said. It's crazy, right? Even Senator Kerry was shocked. He kept asking her to repeat it, and people in the room were actually laughing because it was so absurd.
That's incredible. It sounds like the SBA was actively enabling BLX's bad behavior.
It does, doesn't it?
Yeah.
So after all this, what happened to Allied? Did they face any consequences?
Well, the SEC finished their investigation, and they issued a cease and desist order. Allied had to agree to improve their valuation processes, but they didn't have to pay any fines.
A slap on the wrist, basically.
Yeah, it doesn't seem like much of a deterrent.
No, it doesn't. And there's this whole revolving door situation where a lawyer who used to work for the SEC's enforcement division went on to become a lobbyist for Allied.
Always following the money. So what was Allied's ultimate fate?
Well, in 2008, during the financial crisis, they sold off some of their investments to Goldman Sachs. And David Einhorn, the guy from Greenlight, he gave his famous Lehman speech that year where he warned about Lehman Brothers collapsing. But did you know he originally wanted to talk about Allied?
Really?
Yeah, the Allied story was almost the big headline that day. Anyway, Allied's stock price kept going down, and by the end of 2008, they were in deep trouble. They reported a huge loss, they had a lot of debt, and they even stopped using their fancy loan grading system.
The House of Cards finally came tumbling down. What about the False Claims Act lawsuit? Did anything come of that?
The government did go after Allied and BLX, alleging fraud with those SBA-guaranteed loans. But they ended up settling for a relatively small amount, something like $26 million. And Greenlight, who had initially blown the whistle on the whole thing, they were left out of the settlement talks. They thought the amount was way too low, and they were disappointed that the government wasn't going after the individuals who were in charge at the time.
So a legal resolution, but not a very satisfying one. It sounds like no one was really held accountable.
That's the feeling you get from the source. The book ends by comparing Allied to Bernie Madoff's Ponzi scheme. The author says the main difference was that Allied at least pretended to invest the money, while Madoff didn't even bother.
That's a pretty chilling thought.
It is. It makes you wonder about the different shades of financial wrongdoing. Where's the line between aggressive accounting, being careless, and outright fraud? And how do you hold people responsible when the regulators aren't doing their job?
Big questions for sure. So, what are the key takeaways for our listeners?
This whole story is a reminder that you can't just take a company's numbers at face value. You have to dig deeper and look at the details.
Don't be fooled by the magician's tricks.
Exactly. And it shows how hard it can be to hold powerful financial institutions accountable, even when there's clear evidence of wrongdoing.
And it leaves us with that thought-provoking quote. Arguably, the biggest difference between Allied and Bernie Madoff's Ponzi scheme is that Allied went through the motions of actually investing the customer money while Madoff didn't even bother.
Yeah, what does that tell us about the different ways that trust can be broken in the financial system? It's something to think about.
Absolutely. We encourage our listeners to explore other cases where similar issues have come up. Think about the role of short selling and how well the regulators are doing their job of protecting investors.
And finally, here's a question for everyone listening. How can you, as an individual investor, learn to spot red flags and make smart decisions, especially in a market where information can be hard to come by and people's incentives aren't always aligned?
That's the million-dollar question, isn't it? Thanks for joining us for another deep dive. Until next time.